Hello, and welcome to Questions in Finance, the podcast where we tackle big money questions with fact, figures, and a bit of fun. I'm Kate, and I'm joined here, as always, by my co-host, Veljko. Hi, Veljko.
Hi, Kate. I'm super excited about today's topic. It's one of those classic debates that we have in personal finance and investing, and I think we have some really good stuff to chew on today.
What are we asking today? Is it ever a good idea to have your entire portfolio in stocks? In other words, is it ever a good idea to invest all long-term savings into stocks alone and nothing else? It's a question relevant to anyone starting out investing, perhaps like some of our kids who are about to get jobs and graduate from college, perhaps like some of our college listeners and students, and even some seasoned investors thinking about their retirement strategy, to whom perhaps this idea of being 100% in stocks sounds a bit foreign.
And what I think is fun here is that we have at least a little bit of disagreement. You and I are not exactly on the same page here, so that should make for a lively conversation today.
Yes, Veljko and I were comparing our portfolios because that's what finance nerds do for fun in the evenings. They compare their portfolios, and we noticed some differences.
Yeah, I am very heavily invested in stocks currently. And in general, I tend to keep a heavy equity allocation. My portfolio is 90% stocks or more most of the time. And I have just a smidget of bonds and cash in my retirement account.
I'm more balanced, at least for now. I would say that currently right now, and we're talking about summer 2026, I am about 50% stocks, 50% bonds, and moving more out of stocks. And the reason for that is that I do what we tell our students to not do. I sometimes get in and out of the market. There are times when I am 100% invested in the market, and there are times when I am like 5% invested in the market, and the rest I am holding in cash. So it just depends on my perception of the macro factors. So right now, I'd say I'm 50-50, kind of thinking more towards reducing my stock holdings.
So it's interesting, you're not just tilting more towards bonds, at least now, but you're actually a more active, trying to time the market investor, whereas I'm a little bit more passive, fixed into stocks. But that's where the differences lie. On the other side, we do have at least one thing in common, and perhaps one mistake in common. We both suffer from a pretty serious case of home bias. Most of our stock holdings and most of our holdings in general are in US markets and are denominated in US dollars. Neither of us really has a lot of financial assets or stocks from other countries, which perhaps is inconsistent with some of the literature that we're going to discuss today.
Yeah, and apparently we're not alone in that. A lot of investors actually do this, meaning they participate in the domestic stock market but hold too few foreign stocks. Even worse, the 2024 OECD Pension Outlook, and the researcher there, Stephanie Payette, she highlights that actually pension funds, global pension funds, have very low international diversification. So this is where the big money is sitting at. Some countries' retirement portfolios have tiny percentages, like under 10% in foreign assets. Even though mixing domestic and foreign equity generally increases returns and reduces risks in the long run. So that's pretty eye-opening. It's not only us, it's not only other people, it's also pension fund managers who have been trained to actually execute properly. They also suffer from this home country bias, so to say. So it's basically everyone, not just us. We tend to stick with the familiar local investments, and we don't venture abroad much.
In defense of pension fund managers, a lot of times outside of the United States, pension funds are state-owned, and then there is heavy political pressure on investing that money domestically when it's a government-owned, government-managed fund. So sometimes it's not even a choice, at least not at the level of the portfolio manager. But all of this is true. And as we said, one of the papers that we're going to be looking at today, perhaps the main paper we're going to be looking at today, finds that you should really have not only a substantial portion of your portfolio in international markets and international equities, but actually the majority of your portfolio, according to them, up to 2/3, should be allocated across borders.
Yeah, and so just highlighting it again makes sense. We talked about low international diversification for a reason, because the findings of our research today will say that you should be holding a lot and a lot more than 10% of your retirement portfolio in foreign stocks. We are going to ask, should you have your entire portfolio in stocks? That is a big question. And there's obviously going to be nuances. It's not going to be one size fits all. So it will depend on things like age, goals, and tolerance, and how comfortable one is with volatility. And we have some exciting new research to share with you.
We are going to be citing some academic studies. This is going to be as evidence-based as possible, but we are going to try to keep it friendly and understandable, even when we are digging into some complicated numbers.
Yeah, we will try to translate everything into plain English, have fun with it, and we'll talk about what does research have to say about all stocks all the time versus no, diversify into bonds.
Welcome to Questions in Finance,
a podcast where we translate academic mumbo-jumbo to answer interesting questions in finance. I'm Kate Holland.
And I'm Veljko. Kate and I met when we were PhD students at the University of Oklahoma.
Today, we're university professors, and we spend our days teaching and researching companies, markets, and all things related. Before we get started, I want to say that we are drawing on a set of papers, I would almost say a body of research, that's done by the same set of co-authors on the same data. And the reason why we know, or how I started to learn about this, is that one of the co-authors, Mike O'Doherty, was my colleague at the University of Missouri, and he started looking at the super cool data. It's called the GFD data. This GFD data provides stock returns, bond returns, and bills, and the macro factors. So it has returns going back a really long time, because usually we look at US stock returns from about 1930s to now, so in about 100-year span. These authors using this GFD data go back to 1840s. So they are looking at stock returns, annual stock returns from 1840 till now. And they really have them for a variety of countries, but they concentrate on the 39 countries that they call developed. And developed meaning when 50% of your GDP is coming from non-agricultural sources. So the United States does not enter the sample immediately. It only enters the sample in 1890. So they have very interesting data on stock returns, and then obviously also bond returns and bills, going back to 1840s for what they've selected to be 39 developed countries.
This is the Global Financial Development Database, which is actually a publicly available database maintained by the World Bank.
Yeah.
So in many ways, you gotta admire researchers that make the best out of. This is not a proprietary data set that few people had access to. This is a big data set that anybody has access to. We are all looking at it, and these authors have seen something in it that the rest of us missed. And perhaps we should mention the names of the authors.
Sure.
Mike, of course, is a friend, and we invited Mike to come to our podcast and talk about this manuscript or this stream of research. Mike was busy, but we are hoping that we are going to say some things that are very wrong here today. He's going to be terribly offended and feel compelled to clarify, and then he's going to accept our invitation.
Yeah.
So, Mike, the door is open. We would love to have you anytime if you're listening.
He did mention to me when I was asking him how does he actually allocate his retirement funds, he said that his retirement fund allocations actually closely linked to what they discuss in the paper. He didn't provide the specific, but he said closely linked.
Oh, I love that. That was going to be my first question. Are you 100% stocks? But okay, so we have Michael O'Doherty, and the other two co-authors are?
Aizhan, Anarkulova, and Scott Cederburg.
So they are putting together or using some very interesting and very long-lived data. But there's also a methodological innovation in what they're doing, because they're not using this data as it is.
Correct.
We have a problem when you're looking at these portfolio allocations over a long period of time. You just don't have hundreds of generations. You have 150 years of data. In order to increase the size of their data set, they're doing something that is not uncommon. They're bootstrapping, which means they're drawing observations at random from this existing data, and they're creating a data set that is much larger. And the big innovation in what they're doing is what they call a block bootstrap. Effectively, they're plucking 5 years of data from this sample, blocks of 5 years of data, which, in their words, preserve trends that are displayed in this data. And this is important because traditionally, you're doing this kind of bootstrapping, but you're plucking one observation at a time, so you're not seeing these trends. So they have a big data set, but they also have a new, fairly sophisticated methodology. And clearly, we didn't go into enough detail. If you are interested, you should read the papers.
So what does research have to say about all stocks all the time versus diversify into bonds?
Before we dive into the research, let's clarify, what do we mean with the entire portfolio in stocks? Effectively, what we mean is you have your long-term savings, whatever you plan to invest in your retirement, and the idea is that 100% of these savings would go into stocks.
So we are focusing here on the mix of stocks and bonds, and those are the two main building blocks. Might sound a bit limiting to some people, especially those who want to think about investing in options or real estate. But in reality, most of your portfolios, our portfolios, are invested in a mix of stocks and bonds right now. Just to get everybody on the same page, let's quickly define what these are and what is the difference. Let's define what are stocks and what are bonds. Stocks are shares of ownership in a company. So when you own a stock, you are a partial owner of that company, and your wealth goes up and down with how the company performs. So stocks have historically given higher returns over a long run as compared to bonds, but they're more volatile, meaning more ups and downs, especially in the short run.
It's like a roller coaster sometimes. It's fun when you're going up. It's somehow terrifying when it's heading down. And bonds, on the other side, these are loans, basically, that you're giving either to a government or to a corporation. And today, we're going to be talking specifically about government bonds. That's really what they mean when they talk about bonds in a retirement sense. And these bonds, they tend to pay you a fixed interest payment every year or every quarter or every semester.
We call them coupons.
They pay a coupon, and they generally return the principal at the end, what we call the maturity of the bond. Bonds are stable in the sense that the coupon that you receive is fixed. For the most part, it's fixed. There are exceptions to every rule in finance at the end of the day.
Yep.
But this stability can be misunderstood by investors. Investors will translate fixed income into safe, secure income. But unfortunately, it's safe only in a nominal sense. You know exactly how much money you're getting from a bond, but you don't know what that money is going to be worth. In other words, you're facing inflation risk, which becomes substantial, especially when your investment horizon is long.
And obviously, there's a relationship between the interest rates, inflation, and bond prices. Bond yields will go up with inflation, and bond prices will decline. So for those purchasing new sets of bonds, that's going to be an important consideration. Or for those wanting to sell their existing bonds instead of drawing income on them, that's also a consideration in terms of how bond prices can fluctuate. But All right, so we're talking about a mix of stocks and bonds. So typically what people have been used to hearing is something like 60% stocks, 40% bonds, or 70% stocks, 30% bonds. And if you have ever heard this saying, 110 minus your age or 100 minus your age, both of those are shortcuts of how you typically were supposed to arrive at what is a proportion of bonds that you should have in your portfolio. Now, having said that, today's research is going to run counter to all of this and saying maybe you shouldn't have any bonds. But traditionally, there was this 110 minus your age determines what should be the proportion of stocks in your portfolio. So a younger person should hold more stocks. And
as you age, the proportion of stocks declines.
So let's use an example.
So you, Kate, are 25 years old, of course, right? So
I'm
if you're
not,
using,
okay. Let's jump it up a bit. Let's go to 40. Let's hypothetically go to 45.
So if you use for rounding the rule 100 minus your age, 100 minus 45, that would mean 55% of your portfolio would go into stocks, 45% of your portfolio would go into bonds if you were following this kind of rule. And then as you keep aging, the proportion in stocks keeps declining and the proportion in bonds keeps increasing.
I think the 110 minus your age is slightly more common. So in that case, I should be holding 65% in stocks, 35% in bonds now. And as one ages, you should reduce the stock portion and increase the bond portion. Yeah.
And whether it's 100 or 110, it's wrong.
Exactly.
Really.
They're both like just mental shortcuts.
And that's the conventional wisdom. And let's unpack the reasoning here. The assumption is that stocks generate higher returns, but they also carry higher levels of risk. So by having a mix of stocks and bonds, you can get to a position where you're calibrating to your optimal amount of risk and return, and with a level of risk that declines with age. And to be clear, we should probably start putting some numbers to what we are talking about. The average return on stocks, approximately, what we hear usually cited for the United States, but approximately it holds in this sample of developed countries, it's about 7% per year above inflation. Mm-hmm. Average inflation is about 3%. Average stock returns are about 10%. We would say the nominal stock return is 10%. If you subtract inflation, 10 minus 3, you get 7%. We call that a real return, real in terms of purchasing power. And conversely, if you are looking at bonds, these numbers are substantially lower.
So it's about balancing risk and return here. And the topic is all stocks versus a mix of stocks and bonds. And really, that's again about risk, all stocks versus reward there. And when we say risk, what we mean in finance is volatility, is the uncertainty of the return. Risk is the chance of losing money, especially in the short run. Return is how much of your money grows on average per year. So stocks offer a high expected return. In other words, there's a reward for the risk of holding stocks, and we call that the equity risk premium.
And again, this equity risk premium has been substantial. As we said, stocks have that 7% per year it bears repeating above inflation, whereas with government bonds, you're probably looking at 1 to 2% per year.
Yeah, I'm going to repeat it again because 7% compounded over long periods of time, over decades, that's huge, that's enormous compared to 2%. And that's exactly what draws people to stocks. And what I'm going to throw in is another shortcut that my Uber driver pointed out to me recently, which is called the banker's rule, apparently.
Right. Things you learn in an Uber.
Yeah, we call it the rule of 72. The rule of 72 allows you to figure out how many years will it take you to double your money if you know the interest rate. So it's literally 72 divided by the interest rate. That's a quick shortcut. So if we're looking at 7%, and the rule of 72 would suggest that it takes us about 10 years to double our money. But if we're looking at 2%, the rule of 72 would say it's going to take us over 35 years to double our money. So there's a big difference there.
That's a rule of thumb. And interestingly, in the paper itself, they actually tell us exactly how money grows on an average. They have an example of a person allocating $1 to the stock market over a 30-year period. And in their findings, $1 in domestic stocks grows on an average to $7.45. If invested in domestic stocks, it was slightly higher, $7.80 if invested in international stocks. Now, this compares extremely favorably with bonds. $1 invested in government bonds grows after 30 years to approximately $2.34. And $1 invested in bills are short-term bonds that are even less subject to inflation risk in theory, grows to only $1.32. So again, you invest in the stock market, your expectation is that your capital will grow sevenfold, 7.5 to 8-fold. You're investing in the bond market over this same 30-year period. Your expectation is that your savings will grow by a factor of 2.5 to 3.
And you using these examples is reminding me of another example I just recently read. Since I'm in Albuquerque now, I'm getting familiar with all the local finance pros, so to say. And I read a few pages from the book from Lee Munson. It's called Rigged Money. And he actually provides a really good examples there, I think, of how a person's path to retirement and how much money they have changes over time. Interestingly, he also compares you investing in S&P 500 versus just the 5 largest stocks at the time and what you get. But in addition to that, he provides a path of a person through the 90s and through the 2000s. And I suggest that you guys take a look because the comparisons are just very soul-shattering when you see this person going from over $1 million back to $650,000 and gyrating like that. And that example just came to mind as you were mentioning your numbers.
Because on one side, we are talking about the attractive side of stocks, the growth, but on the other side, drawdowns, declines in stock markets of 10, 20, 50% are not extremely common, but they do happen, especially when your time horizon is a 30-year period.
Yeah.
So you have to be ready to face some pretty extreme short-term volatility.
Yeah, let's think about real historical events. Let's think about the 2008 financial crisis, where U.S. stocks, we're talking about S&P 500, fell over 50%. So imagine you have $100,000 and that becomes $50,000. It drops to $50,000 in a year and a half. If you're thinking about the Great Depression of 1929, U.S. stocks plunged by 80 to 85%. So you have your $100,000, that gets down to $15,000. And then it takes you over 20 years to regain back your pre-crash peak, the $100,000. That's extreme.
And if you were all in stocks during this period, your paper losses were a substantial portion of your wealth. And theory says all of this is temporary. The stock market eventually always recovered. But when eventually means 20 years, that can be not very relevant to some people. And on top of that, if you panic and sell your stock, or if you need capital and are forced to sell while the market is down, then you're locking those losses and you're not benefiting from the subsequent recovery.
Yeah, locking in the losses is the scary part here. And that's one of my big concerns for an all stock portfolio. It's this behavioral side. It's people are emotionally attached to their money. They see it dropping. They take the money out of the market. They panic, which is what happened in the 2008 financial crisis. In the 2020 COVID hit, they took out the money at the low point, and then they didn't put the money back in to ride the recovery. And so they sold off when the market plunged and missed the rebound. The all stock portfolio basically demands that you be like a robot, a steel-nerved person who sees your portfolio drop from 100,000 to 50 and still keeps the money in. Why? Because if you don't, you're going to miss the rebound.
This is a totally unrelated thought that's perhaps a very interesting topic for a future episode. There's research showing that people lose a lot more money by not getting back into the market after a crisis fast enough than they actually lose by being in the market during a crisis. It is difficult to time the re-entry into a market after a crisis. And this certainly does affect things here. For you to realize the equity market returns that these studies are projecting, you have to pass the psychological test of staying invested during the scary times. If you can do that, you benefit from the recovery.
Yeah.
If you can't, being 100% invested in stocks could backfire. But I will just for a moment remember advice that I was given when I was a PhD student. And I wish I remembered whose quote that was. The best thing investors can do is put 100% of their money into a stock tracker and then write the password on a piece of paper and then burn the piece of paper.
Even better, also from some research paper, the best returns occur in portfolios of dead people. Because the dead person cannot move it up.
Because they're not trading. Yeah, that's perhaps an even better quote. You're absolutely right. All right.
Let's consider the time horizon factor here. We often hear if you have a long time horizon, this especially applies to young people, you can take more risk in stocks because you have time to recover. So the logic is if there is a crash, but you're investing for 30 or 40 years, you can wait for the market to rebound.
This idea has quite some strong support in research. And there is a very highly cited paper from 2009 by a different group of authors. Last names Bali, Demirtas, Levy, and Wolf, but we'll put the full site in our show notes. They're asking, does the stock market become safer if your holding horizon is longer? And they introduced this concept of almost stochastic dominance, right?
Almost stochastic dominance. Sounds like something that an autocrat wants, or like a chess strategy.
I don't know. To me, it reminded me to being a little bit pregnant.
Why?
Because you cannot be a little bit pregnant and you cannot almost stochastically dominate. You either stochastically dominate or don't. So I was a little bit skeptical about the analogy that they have chosen, but perhaps your analogy was a little bit more professional. But what do they mean with almost stochastic dominance? They say that one instrument almost stochastically dominates another instrument if for any reasonable investor was not unreasonably risk-averse, one asset would be preferred to the other. They're effectively saying that stocks almost stochastically dominate bonds. For any reasonable investor, they should prefer stocks over bonds. And their intuition here is that things change as your investment horizon lengthens. If you actually look at 1 month returns, on an average, a random stock beats a random bond 60-65% of the time. But if you take a 5-year period, a stock will beat a bond 97% of the time.
Wow.
And if you go from 5 years to 15 years, 20 years, 30 years, now you're approaching 99.9 something percent of the time where stocks beat bonds. And that's what they mean. It's not 100% of the time. There's always a little bit of luck involved. There's always a little bit of rolling the die. But again, any as they put it, reasonable person should conclude that the returns on stocks over a long horizon are more attractive than returns on bonds.
Yeah, I want to repeat that stat. 97% of the time over a 5-year period, that's 97% of the time. So over a 1-year horizon, okay, that's 2 out of 3 times, which still leaves a big chance of underperformance and of losing to bonds. But as the time horizon lengthens, those historically tilt more towards stocks.
And to be clear, these numbers that we just quoted are specific to US markets, where historically stocks have done a little bit better than abroad. But the percentages are very similar. When you look at developed countries, any reasonable person should conclude that the returns on stocks over a long horizon are more attractive than returns on bonds.
I want to play a skeptic here. I think that using US historical data is commonplace, but US has had a phenomenal run over the last 100 years, over the 20th century. So if you look globally, things are not quite as rosy. Things are not quite as great.
We shouldn't assume that every other country will perform as well as the US market. But I think that this point bears a little bit more emphasis in some sense. It's not unreasonable just to assume that other countries will match US returns. I think in some sense, we have to question whether it's reasonable to expect the United States to have the kind of outperformance compared to the rest of the world over the next 150 years as it did over the previous 150 years. In other words, if you buy the idea that in the long run things have to revert to some sort of mean, then looking at returns across the world gives even US investors a better indication about future expectation than focusing specifically on the US market. And I think that's an important, if subtle, point when looking at this paper.
And let me bring up an example of Japan. Back in 1990s, Japan's stock market had a larger market capitalization than that of the United States. So think back to 1990s. So where am I getting this example from? It's actually from a paper called Stocks for the Long Run, which is a 2022 GFE, Journal of Financial Economics, by the same set of 3 co-authors, including Mike. And they're looking at the same countries, but only at the equity returns. And basically, they're saying that stocks are not guaranteed to win even over a 20 to 30-year period in all markets. So back to Japan. So in the 90s, Japan is at the top of its financial power, bigger than the US in terms of market capitalization. And if you had invested in Japanese stock market back then and held it for 30 years, till about 2020, you would have lost about 20% of your purchasing power. 30 years later, you would be poorer in real terms. That's a shock to people who think stocks are always going up in the long run. And the researchers have calculated that on average across all countries that they've studied, that there's a roughly 12% chance, that's 1 in 8, 12% chance that the 30-year all-stock investment would end up losing money after inflation. Okay, in the US, it's almost negligible, something like a 1% chance using historical data. But globally, it's 12% chance. In the US, only 1% chance. But back in 1990, in Japan, people were not thinking that they're going to be falling into this huge market downturn.
The common narrative is if you hold stocks for 30 years, you will never lose money. And all of a sudden you're finding out that never really means 12% of the time. That's scary, as you say, 1 out of 8. On the other side, if you're saying I'm a good old American, I like my burgers and I buy my stocks domestically, why do I care? I have only a 1% chance of loss. Again,
that's historical data, historical. Yeah.
Should we assume that this kind of outperformance will persist? I think that that's very debatable. And it really highlights this idea that the US historical experience might be a particular outlier and that as you're planning for the future, you should not expect the same kind of outperformance.
Yeah. And I think the key finding of the research is that you need to have international diversification in stocks. So even if you are fully invested in the stock market, and we're talking about 100% stocks here, you need to make sure that you are spanning global markets. So you are not invested 100% in the US stock market, that you're actually diversified across other foreign markets as well.
No doubt. The conventional advice here seems to underplay the global angle.
The conventional advice, you mean in general in the US?
I think that the reality is that we are all victim of this outperformance of US markets. We've become conditioned to believe that US stocks beat the rest of the world.
Which they have.
They have in the past. And that has led people to underweight foreign stocks, perhaps in a manner that's dangerous for the future. But one of the reasons that beyond the status quo paper, which we're going to delve into a little bit more detail in the rest of the discussion, found such strong results for an all-stock portfolio is exactly because of the diversification benefits of adding international stocks. By their estimate, a third of your portfolio should be in domestic stocks, US stocks, for the US investor. 66%, 67% should be in international stocks. 2/3 of your portfolio should be in foreign stocks, which is more than twice the average allocation of the typical US investors.
Interesting. So this paper is basically saying that S&P 500 domestic stock investments should be about 33%, and then you should be heavily weighted, like over 60% to the international shares. It makes me think immediately that there's reasons for an all-stock portfolio to be safer because of this global diversification. Essentially, you own stocks all over the world. You're not reliant on just one country to do well. So those in the 1990s in Japan would have been probably pretty happy if they had 66% of their wealth invested outside of Japan in foreign countries.
What this stream of research is doing is they're really using global diversification as a substitute for having bonds in your portfolio. The idea here is that historically, the markets in different countries are weakly correlated. They don't necessarily move up and down together perfectly. So you can cushion some falls, you can reduce the damage from some of these falls by investing in other markets. When one market goes down, another one hopefully goes up, and you're balancing things up. Importantly here, the authors find that when you properly consider multi-decade investment horizons, bonds really do not look that attractive, even as a diversification tool over 30 to 40 years.
You know what this makes me think about is that scene from the movie The Shining where there's a stabbing, because what this paper is doing is really stabbing a knife straight into the heart of conventional retirement planning advice. The conventional retirement planning advice is you're going to be shifting into bonds as you get older. And what are they saying? They're saying that maybe bonds are not that safe.
I will just say, I love the sound effect. And I believe that you're talking about Alfred Hitchcock's Psycho, the stabbing in the shower.
Yes.
Right? That's...
Why did I think The Shining?
Correct.
Okay, so I'm mixing up the two movies, but I have the scene. Yeah, basically, the whole idea I'm trying to say here is that this research is very cutting edge and in a way stabbing a knife into the heart of a big, huge retirement industry, which has told us to do things one way, while the paper saying, wait a second, we're not so sure that's the best way to accumulate your retirement savings.
All of this, when you put it together, means that bonds are not that useful for long-term investments. There are these long horizon return properties that the authors really are pointing out here. The riskiness of bonds and the correlation between stock markets and bond markets vary dramatically, whether you're looking at a short-term horizon and whether you're looking at a very long time horizon. Yeah. As your time horizon lengthens, bonds actually become riskier. And largely that's due to the fact that bonds suffer from the risk of inflation eating up the value of your savings. And that's a risk that tends to manifest itself over long periods of time. Inflation builds up over decades. Stocks tend to suffer from short-term volatility, but in the long run, stocks tend to mean revert, meaning that something that went up subsequently goes down, or something that goes down subsequently goes up. And this mean reversion actually makes a long-run return safer than a short-term return. So ironically, stocks, where your biggest problem is short-term volatility, the longer you go, the safer they become. Bonds, where the biggest risk is inflation, the longer your time horizon, the scarier these bonds are starting to look. And I think that's the core intuition at the heart of these papers.
I think it's interesting that they looked at 30-year outcomes instead of doing just like year-to-year accumulation. It's important because people think in terms of returns to retirement. So looking at a 30-year chunk of time makes sense.
That's why they're looking at this 30-year horizon, and they already showed us these dramatic differences in growth. You're turning $1 into $7 by investing in stocks. You're turning $1 into $2.50 by investing into bonds. But it's not just about growth. It's also about risk. So they also talk about failure rates. Just like when you were looking at Japan, failure is defined as an erosion of purchasing power. So not negative nominal returns, but negative real returns.
Right.
The idea that you're not beating inflation, that's a failure here. In those terms, the probability of losing money by investing in stocks, as you already mentioned previously, it's somewhere around 13%, 12.7, I think, is the number that they have. And that's domestic stocks. It's lower if you're investing in a globally diversified set of stocks. For bonds, and this really deserves trumpets, a drum roll, angels blaring from the clouds, right? Because why are you banging?
I'm making trumpets.
Oh, those are the trumpets. Oh, okay, I'm sorry. Like, what's happening here? Okay, that was, we need better sound effects, better production value. But okay, fair enough. 27%. The probability of losing money in real terms, if you're investing in bonds, the probability that your portfolio will have less purchasing power after 30 years is a whooping 27%. 1 every 4 people that put their portfolio into bonds will actually lose money, will see their purchasing power eroded. And I think that's a very interesting way of thinking about it.
Bonds have a higher chance in the long term of real losses than stocks do, but in the short term, the bonds are safer. I do want to chime in, so with my usual skepticism here. And while the numbers are really deserving some trumpets, with a 13% loss for stocks and 27% loss for bonds over a 30-year period, I do want to point out that losses in bonds are usually smaller and more limited than those in stocks. Of course, we're talking about purchasing power, but the bond has a par value of 1,000, pays interest, and that's what happens. So you can lose purchasing power over time by holding it. Stocks, on the other hand, can be quite volatile and lose up and down much larger sums. So while 13 versus 20%, stocks versus bonds, percentage of loss sounds crazy, I feel like the actual dollar losses on the bond side are just a lot smaller than dollar losses on the stock side, even when we're talking about purchasing power. Still, the higher chance of loss in the bonds in the long term compared to stocks, very interesting.
You're not always better off in stocks, but you have to really have a substantial amount of bad luck for your stock portfolio not to outperform bonds over a 30-year horizon. To be clear, the probability of losing money by investing in domestic stocks over 30 years, we said about 13%. If you're actually investing in international stocks, into a diversified portfolio of global stocks, then the probability of losing money over a 30-year period is actually only 4%. The intuition here is that once you span countries, even that residual inflation risk gets dramatically diversified. And so even a run-up of domestic inflation that is so pernicious to your bond portfolio or your domestic stock portfolio, you are decreasing that risk by investing in foreign stocks.
That's very powerful. I'm going back to the stabbing scene. This is a stab into the...
Can we have the sound effect again, Kate, please?
The retirement industry planning model, where this new research suggests that diversifying with international stocks instead of holding bonds might give you the best of both worlds, higher returns and more manageable risk over the long term. They're telling you that you get better growth and not actually longer term risk than those safer strategies, and I'm putting quotation marks around safer, because bonds have their own sneaky types of risks, especially with inflation.
Let me highlight some of their findings here. They claim that an all-stock portfolio provides not just higher wealth at retirement, and they're talking about 50% more wealth accumulated after 30 years in an all-equity portfolio versus a 60-40 stock bond portfolio.
50%.
50%, yes. Quite a substantial difference
A
in
lot.
accumulated wealth for the average investor in their sample. But they also find that this all-equity portfolio has a lower probability of leaving you stranded in retirement as well. In other words, they're modeling the probability that you will run out of money in retirement. They look at the 4% rule, which we know is fairly common. The idea there is that once you hit retirement, and they're generally modeling that as age 65, then you will withdraw 4% of the value of your portfolio in your first post-retirement year, and then you will adjust that 4% by inflation to keep it constant in a real sense. And that's the common wisdom, is that if you do that, you're going to be fine.
Yeah.
That you're not going to run out of money. In reality, the authors here have some disappointing news for us. They're saying that if you're in a typical 60-40 portfolio and keep it in a 60-40 portfolio post-retirement and pull out 4% adjusted for inflation every year, you have a 17% chance.
Almost 1 in 5.
Yeah, almost 1 in 5 of running out of money before your simulated life expectancy. And an even higher 20% chance of running out of money if you're invested into your typical target date fund, where this targeted fund changed the allocation of stocks and bonds over time. If you compare this to an all-stock portfolio and you apply the 4% rule, then your chance of running out of money before expiring is actually only 7%. Again, probably higher than most people think.
Yeah.
One of the findings here, disappointing, if you will, is that the safe 4% rule is not safe at all. But again, there's a substantial difference between a 17 to 20% chance by having a mix of stocks and bonds and a 7% chance by being in stocks alone.
Yeah, I have to admit the results surprised me. And they're saying 100% stocks is safer for retirement income. Another result that surprised me is that if you're in a typical target date fund, which a lot of our colleagues are, so I think in the university sphere, many people just throw their money into target date funds. And you would think many outside of the business school. I've talked to my colleagues in management, marketing, accounting, and even finance. A lot of those people have their money in target date portfolios. So for them to realize that they have a 20% chance of coming short in retirement, that's huge. So basically, this paper is saying, don't be in target date funds, don't be in a bond stock mix, but this paper is saying, be 100% stocks, but diversify domestic and global. And it makes sense that this 100% stock is a safer retirement, because if you consider, if you have all of your money in stocks, you will end up with a lot more money on average by the time that you retire. So even if a big drawdown happens, you have more of a cushion to begin with.
The intuition, as you correctly pointed out, is stocks drop by a lot occasionally. But the fact that you have this bigger nest egg to start with means you can withstand a big shock and still be better off than if you were just starting with a much smaller nest egg. And again, they said earlier, if you invest in all stocks, you will have 50% more than if you're in a typical 60-40 stock bond mix. And when they benchmark it against a typical life cycle fund, then it's even more dramatic. They're finding that the typical all stock portfolio tends to beat a life cycle investment strategy by a 60%, not 50, 60.
So for our colleagues who are in target date funds, those university academics, take note that you being in the target date fund, you're setting yourself back by over 60% in terms of where you're going to be in your retirement compared to what you could have if you would be invested in all stocks, but diversified domestically and in foreign stocks.
I love the way they describe some of these. In their base model, they have an investor that saves 10% of their salary. In one, I think, insightful way of looking at it, they're asking, okay, you have this base investor that puts 10% of their salary away and puts it all into stocks. How much would you need to save to end up at the same point if you were investing either a 60-40 portfolio or a target date portfolio? And the numbers are quite substantial. If you invested 60-40, you would have to put aside 16%, not 10%, but 16%. And if you were investing into a target date fund, you would have to save 19%. You would have to almost double your allocations to save the same amount or to end up at the same point 30 years later.
Yeah. Yeah, but again, we are assuming that nobody's panicking. They are very comfortable seeing their money go from $100,000 to $50,000, and they don't move the money out of the market, that they can all handle these downturns. And basically, there is a big behavioral aspect here that keeps coming back. Can people do it?
The best strategy only works if you can stick with it. If your entire portfolio is in stocks, when the market tanks, and it will, at some point, you have to have the temperament to not sell low and lock in your losses. If you bail out at the bottom of a crash, you are basically undoing all the advantages of an all-stock strategy because you're going to miss the subsequent rebound.
Yeah, but of course, you want to be the super lucky person who withdraws your money before the low and puts it in at the low, but this timing is extremely difficult. And I might sound like a broken record here, but I'll repeat it again. The psychological difficulty of an all-stock portfolio is not trivial. Many people have much less tolerance for big losses than they think they do. It's easy to talk about it until you actually see these drops in your actual dollars.
In defense of the studies that we are looking at here, they try to use a life cycle model that accounts for variation in wages. They're incorporating social security contributions and payouts. They are allowing for withdrawals for emergencies. And so they are being quite sophisticated into trying to model the various life events that could affect somebody's savings. But again, they are assuming that investor will have ice in their veins.
Anyways, getting back, did they actually talk about why exactly the bonds add so little value? That's puzzling. What do they say about that?
It really comes down to the interaction between the long horizon properties of bond returns and the way inflation tends to manifest itself over time. Bonds look very safe in the short term, but they have almost hidden risks in the long run. Over a 30-year period, bonds become a lot riskier than you think because small interest rate changes or small increases in inflation over time compound to a pretty large number over a 30-year horizon. And that's partially because inflation tends to have some persistency over time. a year of high inflation tends to be followed by another year of high inflation. Inflation grows slowly, but declines also slowly. So if within that 30-year cycle, you get trapped into a decade like the 70s with double-digit inflation, then that can really eat up a substantial value portion of your portfolio.
Another interesting detail I noticed, they mentioned the target date funds, which most people think that it's a prudent investment, that they do indeed have smaller typical losses in normal market downturns around retirement. But they pointed out that if you get a really nasty scenario like runaway inflation, those bond-heavy portfolios will get hammered, whereas all stock portfolio, which is riskier in normal times, might weather inflation better. Why? Because if you think about a company like McDonald's, Home Depot, they can pass on some of the inflation onto their customers. So they have a bit of a balancing act there between sales and costs. So there's a trade-off between different kinds of risk, market volatility versus inflation risk.
You really have to pick your poison here. Stock-heavy portfolios have a lot of market volatility risk.
Up and down.
Absolutely. Bond-heavy portfolios tend to have more inflation risk, which leads to some shortfall probability, the idea that you just don't accumulate enough. And long-term investors concerned with maintaining real wealth, they are really affected more, at least in the words of the authors that we are discussing here, long-term investors are really affected more by inflation risk than they are by short-term volatility. Because again, the short-term volatility in stocks tends to be mitigated by long-term mean reversion, by the tendency of losers to become winners in the subsequent period and of winners to become losers subsequently, which smooths things up over a long period.
Yeah, so this international diversification creates a better path for stocks. So I'm glad that you're mentioning different types of risks. So you talked about market volatility risk and this inflation risk. One way that I think about it is stocks can go through severe crashes, like the 2008 crisis, but in the end, they tend to climb and compensate if you've had enough time and you stayed in the stock market. Where if we look at bonds, they probably will not crash like 50% overnight, like the stocks did in the 2008 financial crisis, but they quietly lose purchasing power over years of inflation. And they just might not grow enough to meet your goals. Both are dangerous, losing a lot fast or losing slowly by not growing enough.
Yeah, in some sense, it feels almost like the trade-off between a car crash and death by 1,000 cuts. And these are exactly the considerations at play for investors that decide whether they should be 100% of the time. And we did mention that time horizon matters.
I like that. Let's structure this by considering different scenarios because that's worked before.
Okay, so maybe we can pull out some imaginary investors. And we actually asked our highly sophisticated AI platform to come up with 3 prototypical investors. Okay, so my AI printout here in my notes has Alex. Alex is age 22. I suspect it's a he. I guess Alex could be a he or a she.
Yeah, so that's my first modification. I'm going to have an Alexis, age 22.
Okay, so we're doing feminism here. But Alex could have gone either way.
Not feminism. We are equalizing 50% of population. So go ahead.
Okay, so Alexis is age 22, just started working, and has multi-decades of investment horizon. Blake, is Blake male or female? That's another ambiguous name.
Blake is also a male.
Blake Lively is very female.
Oh, okay. I agree. Okay, we'll keep Blake. That's a very name that can go either way. Okay.
I actually, let's give credit to our AI.
Okay.
It shows Alex, Blake, and Sam. All 3 are ambiguous if you think about it.
What about Sam? Sam sounds like a very boy name to me.
We have an advisor that's Samantha. She goes by Sam.
Oh, Sam.
I think you're being tremendously sexist here, Kate.
Wow.
You're just assuming that Alex, Blake, and Sam are all male, whereas All right. So Alex is 22, just started working, has multi-decades of investment horizon. Blake is 45, mid-career, has some intermediate goals and some financial needs, paying for kids' college. And then we have Sam. Sam is 65, about a couple of months away from retirement. And Sam is going to depend on his or her portfolio for the rest of their retirement.
Okay, perfect. So let's start with Alexis, 22-year-old go-getter, fresh out of college, first job, presumably doesn't need this money until retirement, which is over 40 years ahead. So is it smart for Alexis, to put their entire portfolio into stocks?
So both Alex and Alexis having a very long investment horizon. And by the way, life expectancy for women is longer than for men. So, right, maybe we are being all glib about it, right? But there are gender differences here, right? But they both have a very long investment horizon. Presumably, they won't touch their retirement for 40 years or more. And their human capital, that is their expected future earnings or their ability to earn in the future, also affects their optimal portfolio choice, because that's a steady stream of income. And since they're young, they have a lot of time to recover in case of a market downturn. They can just keep investing.
Yeah. And actually, the conventional wisdom, even if we look at these target date funds, which we've been downselling in a way in the light of this new research, even those target date retirement funds, they still allocate about 90% into stocks for young people. And the main reason here is that the horizon factor, they just have such a long time until retirement, so they can bounce back from any losses. For somebody who is that young, a super stock heavy portfolio is usually recommended. And this paycheck for Alex in the future is like a bond stream. So ironically, Alex is in a way diversified in the sense that he has a stable salary or she has a stable salary. So if Alex's personality can handle being invested in the market even during very volatile periods, 100% stocks in their retirement account is reasonable. But I would mention that they still should have cash for emergencies. Now, I have to clarify, this is not what the paper states. This is just a personal opinion and kind of advice out there that's been commonplace, that it makes sense to have 3 to 5 months of your expenses put away into something like cash for emergencies account. So while we're saying entire portfolios in stocks, we're talking about your long-term retirement portfolios. But I would personally add, we're not talking about every dollar that Alex has. I would suggest that having a cash cushion, 3 to 5 months of expenses, is very useful here.
What we're talking about is your long-term savings. You probably should have an emergency fund aside. The authors are not necessarily talking about that. They're concentrated on your long-term savings. And I think that we really need one more clarification here. If Alex is going to go 100% into stocks, Alex or Alexis, that should be diversified stocks. We are not saying, hey, put 100% into one company.
Right.
We are not talking about putting 100% into a single company or two companies. We are talking about a diversified stock market index. And again, we are talking about diversification across firms and across countries.
Yeah, across countries. Diversification is key here. Though, I would say there's opinions and opinions here. So back to Lee Monson, he provides an example in his book of holding 5 largest stocks versus holding an S&P 500 portfolio. And I think that he says if you have the time to be a somewhat active investor, reading the 10Ks, looking at the companies, keeping a diversified portfolio of a smaller subset of firms than S&P 500 can work for an active investor. But again, all of us are busy. We don't have time to read 10Ks annually or 10Qs quarterly, the financial reports of the companies. So for those of us who don't have the time, diversified portfolios make sense.
I guess reasonable people can differ here, and you did say it was controversial, but I don't think that I would feel comfortable recommending to any active investors to try to stock pick. I think that the evidence is that the majority of people would try lose money. But We can just agree to disagree on the wisdom of active investment. I think that what we agree on is that for the overwhelming majority of people, passive allocations, they're well diversified, make a lot of sense. Now, we did talk about Alexis, our 22-year-old with a long horizon. What's next?
The second person after Alex is Blake, who is 45. So let's say Blake is mid-career, comfortable, but perhaps kids are starting college soon. And so they need to pay for the kids' college, and perhaps there's a home upgrade that's happening. And they're about 15 to 20 years from retirement. So how should Blake invest? Should Blake be all in stocks?
The reality is that once you are at that kind of age, you're probably having some outlays. You're probably thinking of paying for a house, or you're thinking of paying for kids' college. So at least some of the money that you're setting aside really does not have a multi-decades investment horizon in front of you. You know that some of the money that you're setting aside, you might have to pull out within the next 5 to 10 years, if nothing else, to pay for college, to upgrade your home. And the more short-term liabilities or the more short-term expenses you have, the more it's going to make sense for you to put a proportion of your portfolio into bonds and cash.
Yeah, exactly. But so maybe carve out a part of the money and invest it conservatively, so to say. For the rest, Blake's retirement timing is still 15 to 20 years away, which is shorter than 40 years. So a lot of advisors, like the traditional advice for retirement, would say that Blake should be 80% in stocks, 20% in bonds, or something like that. However, again, this is not the idea that the paper suggests.
They explicitly model allocations over the life cycle of their investor, and they find that for all investors prior to retirement and for all what they call reasonable levels of risk aversion, non-extreme levels of risk aversion, the optimal allocation is entirely into stocks. What changes is how much domestic versus how much foreign. But I will say that they are being pretty strong with that message. We started by saying one size does not fit all, and yet, to some extent, the message of this paper, if you buy this paper, is that the optimal allocation changes very little over the life cycle.
Yeah, so basically there's no magic switch point where it's more beneficial to start buying bonds or adding bonds. There's not a certain age that this paper suggests.
That's right. In their analysis, even if you allow the hypothetical investor to change allocations over time, they would again move allocations between domestic and foreign stocks, but they wouldn't necessarily invest any substantial amount in bonds. There is a slight exception, and perhaps we can talk about it when we get to our third investor. They are saying that an investor in their early post-retirement year might want to hold a buffer of bills, not bonds, but we'll get there.
Yeah, so basically, a person like Blake, who is comfortable with volatility and doesn't need money for the next 20 years or so, still might optimally choose to be all in stocks. However, in reality, 45-year-olds usually prefer to dial things down a little bit and to allow themselves to sleep easier.
To be fair, they talk about optimality, but sometimes deviating from optimality does not change things dramatically in their models. So, for example, they're showing that the difference between 100% stocks and 90% stocks, it's not necessarily dramatic in terms of expected returns down the road, and perhaps does smooth the ride a little bit. But again, strictly speaking, their optimality is 100% stocks.
Yeah, but we've talked about a young investor, a mid-career investor. Let's now consider Sam, age 65, at retirement. And Sam is about to start drawing down the portfolio. Should Sam be invested in an all-stock portfolio?
Let's be honest. Most people in Sam's shoes would not be comfortable 100% in stocks. Because again, there is what people in the retirement industry call sequence of returns risk. In other words, this idea that the drop in the value of your portfolio cuts very differently depending on the moment at which it happens. Think about an investor that's 65, that is just retired. If the stock market drops by 20%, you're losing 20% of your returns immediately. You probably have to lock that in because you're in retirement, you need to sell at least some shares. And then for the remainder of your retirement, you not only don't have that portion of your portfolio, but you're losing also all the returns that would have otherwise generate. Versus think about that same investor that suffers a 20% loss 20 years later when they're 85. They've already spent half of the retirement account by then. So this sequence of return risk leads people to be particularly conservative in their retirement allocations early on in their retirement.
Early on in their retirement. Yeah, so if Sam retires and early on, 6 months later, a huge crisis, a shock like the 2008 financial crisis hits, that slices their portfolio in half just as they have retired. And they probably need to take out the money to pay for some of their living expenses during that downturn, which is like a double whammy. The portfolio is down and they're selling shares at these cheaper, depressed prices, which means that when the market recovers, the portfolio might not fully bounce back because you cashed some money out at the low prices. So that's why as you get into retirement, having some bonds or cash is so valuable for investors. It creates a buffer to where you're not forced to sell stocks if they decline and go down. Instead, you can spend the cash buffer. So again, we're talking about early in retirement here. And you correctly drew the difference with what happens later in retirement.
No, absolutely. If you look at the life cycle, the Beyond the Status Quo paper, the 2025 Beyond the Status Quo paper, they actually look at optimal allocations across age. And it's almost always all equity, except for the early retirement years. So in their model, somebody at age 65 optimally would switch from an all equity portfolio into a portfolio that's 80% equity and 15 to 20% bills. Not bonds, but short-term obligations, bills, because those are more resilient to inflation while providing you that buffer. But again, it's a 20% allocation in the first year of retirement. It quickly shrinks to zero within 5 years. And if you really look at, there are really not substantial differences between somebody that's 100% stock at age 65 and somebody who's 80% stocks, 20% bills, according to their simulations. In other words, the hypothetical investor, Sam, if he or she sticks to 100% stocks across the entire retirement, that's actually not a bad outcome. Again, according to what they are projecting.
Yeah, since we're talking about retirement here, we need to talk about withdrawal rates because people in retirement usually are forced to withdraw a certain amount of their retirement money or do withdraw some money. So the same co-authors, the same three plus Richard Sayers, have a paper titled Safe Withdrawal Rate. Traditionally, basically, we assume that retirees withdraw 4% of their retirement portfolio over each retirement year. So they say that the 4% traditional rule is too risky. In global historical scenarios, the 4% annual withdrawal rate had something like a 17% chance of depleting your portfolio over 30 years versus only 3% if you just looked at the US history alone. So, okay, those of us in the US can say, hey, I can withdraw 4%, no problem, because the risk for me of depleting things down is only 3%. But again, we never know whether the history and US being as lucky in their returns will continue to go on. We certainly hope so, but so did Japan in the 1990s. So that's cautionary, and it suggests that a retiree like Sam might need to withdraw less, maybe 3% or even less to be truly safe given the world again. Or Sam should at least have a plan B with some flexible withdrawal scheme or some guaranteed income.
We are telling everybody, hey, if you pull out 4% a year, you will be okay. 1 out of 5 is not, right? And again, do you buy the idea that the world is representative of the US future, or is the US representative of the US future? In which case, 4% might be okay if you're 100% in stocks.
Yes. This all is a bit depressing. This study also finds that, let's think about the worst case scenario of running out of money. So if you want to reduce that from 17% to, let's say, 5% chance, and you are invested in a target date strategy, which again, most of our colleagues are, you should be withdrawing something like 2.1% of your initial balance per year. If you are in that 60-40 bond mix portfolio, you should be withdrawing 2.3% a year. Both 2.1 or 2.3, they're way lower than 4%, which was assumed before. Super sobering. And the authors were very frank about US data being deceptively optimistic because the world has had some nasty scenarios with wars, hyperinflation, and depressions.
Looking at stock bond allocations, your safe withdrawal rate increases the more you have in stocks. For the overall sample of developed countries, the safe withdrawal rate is actually around, I think, 2.5%, 2.3%. If you are 80% stocks, 20% bonds, it's only about 1% if you are invested 100% into bonds. And again, the more you shift towards stocks, the higher that safe withdrawal rate is, regardless of whether you're looking at US data alone or across the world. The core message, you should stick to stocks and not to bonds, remains. The more you focus on the US, the more attractive stocks look. The gap between stocks and bonds opens up because the US stock market has been such an outlier. But even if you take your typical average European country with a middling stock market, you're still better off in stocks than bonds, just not as much as Americans.
But I want to circle back to the point that bonds still have a place for many investors. Besides what these papers that we're discussing are saying, bonds might not maximize your wealth, but they do serve a point of stability in the short term. Major financial advisors or pension plans, pension funds, they are probably very unlikely to be 100% in stocks for all ages. In fact, in the US, regulation forbids you from using 100% stock as a default retirement portfolio, as a default, not in general, because they're citing that bonds are safe.
It's not just that we teach this diversified approach, mixed stocks and bonds. It's not just the entire retirement industry seems to be based on this idea that there is a magical mix of stocks and bonds that's optimal. This is actually seeped into regulation. We consider it prudent for investors to have this kind of mix, and then any fund manager that doesn't follow these prudent rules is opening themselves to some degree of liability in case of losses. I think that makes these papers even more important because we realize how ingrained the common wisdom is and how important it is to have really good facts.
It's back to that instead of mixing bonds and stocks, what these papers are saying is that you should diversify, but you should diversify by holding different types of stocks, domestic and international.
The fundamental intuition here, why diversifying by adding international stocks makes more sense than diversifying by adding bonds. And again, we talk about bonds and stocks having weak correlation, but the reality is over a long time horizon, domestic stocks and domestic bonds have a higher degree of correlation, a greater tendency to move together than domestic stocks and foreign stocks. So in other words, compared to bonds, foreign stocks give you greater diversification and higher expected returns. So really, it's the dominance here is international stocks dominate domestic bonds.
Yeah. I think we have talked a lot and made a lot of interesting and good points. And this brings us to a summary. So I would suggest we do a pro side of being all in stocks and then con side or against side of being all in stocks. What do you think?
Yeah, let's go for it. So what do you have for the pro side?
So historically, stocks have had much higher average returns than bonds or cash, especially in the long term.
And that actually translates, again, to this idea that the longer you hold stocks, the greater the odds that your stock portfolio will outperform bonds.
Yeah, and this new study suggests that globally diversified all stock portfolios can actually give you better outcomes for retirement. More money and even a lower chance of running out of money compared to a conventional stock-bond mix. They especially highlight the benefit of international or foreign stocks, and they argue that bonds have hidden long-term pitfalls because inflation risks really make them less attractive.
So ultimately, for the Alexes or Alexis, for the young investors with 40 years of savings in front of them, it's pretty much a no-brainer. You probably should be, if not 100% stocks, pretty darn close to that.
Good. So those are the positives and the pros. Let's also talk about the negatives and the cons of an all-stock portfolio.
The first one is volatility. Stocks crash. And we've seen instances like 2008 and the Great Depression where stocks have lost 50% of value, 80, 85% of value. And if your whole portfolio is in stocks at that moment, you're going to be hurting.
Yeah. Another con is behavioral risk. When there's more volatility, when you see your money going from $100,000 to $50,000, you're going to be a lot more tempted to panic and to sell, perhaps because you're losing sleep. And if you get out of the market in the wrong time and then don't get back in, you're going to forego a lot of income. So this behavioral aspect, behavioral risk of staying in all stocks is very valid, I think.
Even if you play the game perfectly, even if you don't make any knee-jerk moves or any panic selling, you still have roughly a 12% chance of losing money over a 30-year horizon by investing in stocks. Now, again, perhaps 12% is a bit high, estimated from a US point of view, but you're far from guaranteed a positive return.
Yeah, and another con to an all-stock portfolio comes to our Sam, who is 65 and just entered retirement. We said that they are really exposed at that point and that a big decline, a big shock to a market will really deplete their retirement savings and force them to withdraw at the wrong time. So Sam, who just retired, actually is advised to not have 100% stocks. So that quickly tapers off.
This about sums up the pros and cons. Did this episode change anything about your views? Are you going to tilt your portfolio more into stocks now, or?
So right now, given my macro outlook, I don't think so. But I think when I'm ready to get back in, I will probably consider more international investments. And I'll probably start researching some of the European stock market indices and Asian as well.
Interestingly enough, in Beyond the Status Quo, they have results conditional on different macro environments and even conditional on different levels of stock prices. And even when stock valuations are high, they still say you should go into stocks. But I understand all of this is conditional on this idea. Do you buy the results of these papers? And I think that for those who are not used to looking at finance research, you have to understand that there is no perfect data set here. You can look at simulated data, make some assumptions. What does the distribution of returns look like? Traditional finance assumes returns are normal and identically distributed. Those are technical terms. But we know that those assumptions are not very correct. They work in the short term, but over a 30-year horizon, small distributional mistakes make big differences. So that's not optimal. So then you can look at real-world data And then the problem is there's just not enough of it. We haven't had thousands of stock markets over thousands of years so that we can create statistically robust insights. And then the third option is you use some fancy methodology like this kind of block bootstrapping to go from 140 years of data to a much larger data set. And each one of these approaches is imperfect in its own ways. The authors here are trying to convince us that their methodology is best, and it certainly has a lot of advantages as far as we can tell. But again, take everything with a grain of salt and realize that the past is an imperfect guide for the future.
Excellent. Until next time, happy investing, and don't panic when there is a big decline in the market.
Absolutely. And when you do panic, send us your questions at questionsinfinance.com.
Excellent.
And we shall provide a little bit of calming reason.
Yeah. Please recommend us to your friends and colleagues and parents or grandparents.
Absolutely. Cheers.
Bye.